they've been working.
Thanks for tuning in to the Mutual Fund Show. My name is Neeraj Shah, and well, it's a very interesting topic that we're going to be discussing today amidst all the question marks surrounding what's happened in the ILFS and then what the mutual funds have done with corporate groups on the credit schemes. We are going to talk about debt funds and why they are good. So yes, it's an interesting one, the next 20-25 odd minutes. And the guest today, needs no introduction really, Vijai Mantri. He's been on our show a number of times and is on the show today as well. Vijai, thank you so much for taking the time out and joining us. Vijai, I want to start with the big question of the day. And the big question of the day for the week, arguably for the month, is that with the new nature of standstill agreements that some of the AMC houses have entered with corporate groups, it's happened with the Z group, it's happened with the ADAG group. Are investments into debt funds or credit funds safe?
I think, in my opinion, the debt mutual fund has been a very good instrument traditionally, and I still think even today it is not a bad instrument. But if someone have a concern about what they are hearing in the market and they want to take a call, then knee-jerk reaction should not be the right thing to do. So I can tell what investors should do in few steps. Number one step is that they need to consult their financial advisor and sit across with them and figure out. Point number one is that look at their own mutual fund scheme in which they have invested and figure out, are these schemes exposed to any of these names we have discussed. If the answer is yes, then the second step is that to figure out how much percentage of that scheme's AUM is exposed to these names. Do you have that number? Then you need to look at what has been the exit load in these schemes. Suppose the exit load in that scheme currently, the investor is running on the investment, is more than the exposure to these groups, then this doesn't make any sense to take money out. If there's no exit load or exit load is lower, then investor need to take a call what one need to do. But there again, you need to keep in mind the tax consideration, because if you are already in the scheme for more than 2 years, then waiting for one more year, the entire tax come down from 30% to 10%. So that call one need to take with the help of an advisor. And suppose you don't have advisor with you, then you can send your portfolio to JRL Money. We will review portfolio and give you, in our opinion, the most appropriate advice. So investor, doesn't have sleepless night, which many debt investors are currently going through.
Okay, while you're at it, tell us, how do people send the portfolios to you?
They can send across to our website, jrlbuddy.com, log in and send across their portfolios, and through Twitter, through Facebook, they can just contact us and our team will get back to them.
Okay, so that's one small thing that can happen if you don't have an advisor, if you're not sure what kind of advisor you should keep. Vijay Mantri and Team JRL are happy to help you out on that front as well. Okay, now to the topic at hand, debt funds. And a lot of viewers, the reason why we picked this topic was because a lot of you would have heard in the past that you shouldn't park your money in savings account or fixed deposits because they don't offer you optimum returns. Instead, do it in mutual funds and they'll give you a better bang for the buck. And then the last 6-7 months, you would have heard a lot of people say that we are scared with what's happening around ILFS and some other schemes, and therefore we're not quite sure whether we want to keep the money in mutual fund schemes because we don't want to make a higher, we don't mind not making a higher return, but we want the return, we don't want the money to get eroded. Now, before we get started with this topic, Vijay, is there a risk for any of the investors due to whatever, not just the agreement that they've entered into, but otherwise, for the money to get eroded, or will it only be a very small case-specific thing? And even in those cases, the exposure, as you mentioned at the start of the show, the exposure in that scheme to some of those suspect accounts would be a question.
I don't think it is going to be a systematic issue for the industry as a whole and even for the debt investors as a whole. I think it is going to be in a particular specific pockets. And suppose on the fixed income side, you have a more diversified portfolio, then you have to lesser to worry. There's a one part of the answer. The second part of the answer is that we'll show you the numbers in spite of all the challenges. You see the investment performance of debt mutual fund in the current market condition. So my question again is that not every debt mutual fund scheme is exposed to these 4-5 names. There are many debt schemes which are running top quality portfolio, and you can look at investing in those schemes. So if you are out from the exit load window, then perhaps that is the one thing you can examine.
Got it.
So not everything is lost out. So my advice to investor is don't panic. Reach out to your financial advisor and take appropriate action.
And build a portfolio of debt funds.
Build a portfolio because like equity, same thing in the debt. You should be investing when there's a lot of noise in the street.
And is the time ripe right now for investing in debt funds? Why do you say so?
Absolutely. Because if you look at, for instance, current portfolio yield of many debt mutual funds, they are above 8.5 to 9%. And suppose you invest in the month of, say, Feb or March 2019, and you take money out, say, in April 2022, you are investing for 37 to 38 months. But since you are covering for 31st March, 19, 20, 21, and 22, you are going to get 4 indexation benefit. So your tax efficiency improved quite significantly. So if you invest currently in a debt market and take money out, say, in April 2022, based on last 3-4 year data where the CI has been, the cost inflation index has been just mere 3.3%. If you just take that number, long-term average has been 6%. But suppose you take that as a base number, your tax rate on a debt side comes down lower than equities. So it makes tremendous sense to look at investing in a quality debt scheme over a 36 to 37 to 38 months, and you end up making much more money than what your traditional fixed deposit could offer you.
So let's talk about those returns. Now, you, of course, in your papers or your presentations, when you look at the annual returns, the debt fund CAGR returns, this is, I believe, presumed over a 3-year period.
Yes.
At 7.5%. The fixed deposit rate offered by SBI in 2016 at about 7%. There also have been some fixed deposits which have given higher returns too.
Yeah, absolutely. So we took SBI because SBI is the biggest bank on the in India. But if you look at other banks, which are like top-end private bank, HDFC, ICICI Bank, Axis, or you look at other PNB and Bank of Baroda, the average rate comes out to around 725 to 730.
Okay.
So 25 basis point here and there. What we did for our comparison, we went back 3 years and looked at 2016 Fab and looked at what was the fixed deposit interest rate offered to 3 to 5 years FD. That is the right comparison. Then we also went back and looked at in Fab 2016 or March 2016, from that day till this 2019, what we are sitting today, about 3 years period, what has been the average debt fund return? So we looked at the entire debt category. We have taken out liquid fund and we have taken out money market and call fund and ultra short term because they are short duration fund. We have taken everything else except that. We have taken gilt, we have taken corporate bond, we have taken credit fund, dynamic fund, we have taken the entire category. The return has been 7.5%. And in that, your fund, which had all these challenges. So in spite of that, the category average has been 7.51% CAGR compounding for the last 3 years in the most challenging market.
Okay. And there is a tax benefit, added tax benefit on the debt funds. Would you explain that?
Yeah, I can explain you. For instance, suppose let's look at somebody who is in 30% tax bracket.
Okay.
Start with that person.
We can start with that. I was just wondering if you can just mention how does this tax benefit come about? I believe there's a power of indexation or otherwise.
I thought let me explain through illustration.
Okay,
suppose you have a 1 crore invested in fixed deposit.
We are right now talking about somebody who's in the 30% tax bracket.
30% tax bracket.
Okay.
So suppose somebody has invested 1 crore in fixed deposit. And suppose he's coming into 30% tax bracket. So after all these surcharges and everything, his tax rate is around 34%. So on 1 crore rupees, he's earning say 7 lakh rupees annual interest. Out of that, he need to provide 34.5% around tax. So that he need to take out of 7 lakh rupees. So 1 crore, 7 lakh minus the tax outgoes, then the rest 1 crore, 4 lakh around that kind of money get invested for second year. Then on that you compound at 7%. Then again next year you need to provide tax. Then third year you need to provide tax. So effectively your 1 crore which you invest in a FD, net of tax, that amount works out to be around 1.14 crore.
Yeah, it is 1.14 crore.
1.14 crore post-tax. There's a post-tax. So pre-tax the amount is
1.22.
1.22. No, I don't think that is the amount. That is, I think, is a debt mutual fund calculation.
No, this is the fixed deposit calculation.
Fixed deposit.
Yes.
So 1.22 and our net of tax after 3 years has become 1.14 crore rupees.
Yes.
Now, if you look at the same number in debt mutual fund, and let's assume we see what happened in last 3 years, we're going to replicate it in next 3 years as well. So there's no intermittent tax liabilities. In first year, there's no tax liability because the way the mutual fund has been structured. In fixed deposit, what you get is interest, and interest get accounted every year in your annual return. In mutual fund, until unless you trigger a redemption, the capital growth doesn't become part of your income.
Okay.
So it doesn't get taxed in 1 year, in 2 year, and 3 year till you take money out. So the power of compounding of that tax portion which goes out in fixed deposit get reinvested in the debt mutual fund. So if you do a comparison between debt mutual fund and a fixed deposit, what you'll figure out on a 30% tax bracket guy, mutual fund deliver in absolute amount around 50% more than what an FD would have done to you. And I'm talking about a market in which we have seen all kinds of challenges.
Sure. So let's get that math up. And this is for the guy who's investing about 1 crore in the debt fund at a tax rate of about 30%, if you can get those numbers up on your screen. So value after 3 years and 1 month, pre-tax 1.25 crores. The tax paid with the indexation benefit is about 2.63 lakh. I think that's where the kicker is, right, Vijay? That the tax paid is much lower.
So suppose you see your investment is 1 crore, the 1 crore has become 1.25. So 25 lakh rupees your gain on the fixed deposit on the debt mutual fund, on which you are paying 26 lakh, 2.63 lakhs tax. So your effective tax rate is 10.5%.
Yeah. I think the viewers, just so that you don't get confused, the third row, which is the indexed purchase cost, is the more important thing. If you see some of the other mutual fund shows in the past, we've told you about the benefit of indexation and how it gets calculated. But this is essentially, so once you get that, you will realize there's math out here. But your indexed purchase cost becomes 1.13 crores, your total value at whatever it is, and therefore, which is why the tax paid at the highest tax bracket comes to only 2.63 lakh versus the same tax paid if the amount had been invested in a fixed deposit is 7.77 lakh rupees. So that tells you how the difference comes about, right, Vijay?
There's the one part. Second part, it is very important we miss out that every year the tax outgo is there, and on that you lose compounding for next 2 years.
Of course.
Then next 1 year. So that also matters a lot. So when we say fixed deposit is for 3 years, effectively fixed deposits are not for 3 years. You do for 3 years, then and when the maturity date come, you again reinvest for 3 years. So people are pretty long-term invested in fixed deposits. So I showed you the calculation only for a 3-year period, but suppose you extrapolate over a 5 or 10-year period, then debt mutual fund over a 10-year period has delivered 100% more return than an FD in absolute term.
Okay, let's also talk about somebody who's got a tax bracket of 20%, Vijay. You want to run through that example too, and let's start off with the investment in what, fixed deposit or a debt fund?
Yeah, we do the same thing. So
okay,
if you look at for fixed deposit, again, the number is same. Your 1 crore has become 1.22 after 3 years. Your purchase cost is 1 crore rupees. On gain, you have paid 5.22 lakh rupees tax. So your post-tax cash inflow in FD is 1.17 crore if you are in a 20% tax bracket.
And if you indeed had that money while being in the 20% tax bracket, and if you invested that money into the debt fund, let's get that math up on the screen.
Then it is, the final number is 1.22 crore rupees. So even somebody who is in a 20% tax bracket, the debt mutual fund did better for you in last 3 years.
Yeah, and similarly for the 10% too. I think the numbers stay same by and large for mutual debt investor, debt fund investor. Even on the 10% bracket too, I mean the value after 3 years, even if in the lowest bracket and say you got a windfall of 1 crore rupees, your value after 3 years in a fixed deposit would be 1.2, which will be lower than the mutual fund, debt fund investment any which ways. Vijay, the question mark would be, and before we get to some schemes that you guys may like, how does one pick and choose what's the quantum of money that should be put in a debt fund? And let's say for somebody who's not comfortable sharing the details with an advisor but wants to try and take the call himself, are there any high frequency alarm bells or indicators that one should keep in mind before choosing a debt fund?
I think debt funds are much, much simpler to invest with. The first rule is that you look at average maturity of a debt fund. Average maturity of a debt fund will tell you what is the maturity of weighted average maturity of all the securities in a particular debt scheme. So suppose you are investing in a liquid fund and it said average maturity is 45 days. It means that all papers of that liquid fund have a maturity of 45 days. This means after 45 days, new paper need to be bought in. So suppose your investment horizon is anything between 1 day to 3 month period, liquid fund is the right option available for you. So whenever you look at investing, the first rule you should look at is that you figure out what is your investing horizon and then pick the scheme which is 2-3 months lower than the holding period is. Suppose you are investing for 3-year period, then you need to figure out a fund which have a 2-year 6-month maturity, 2-year 9-month maturity, and these informations are available readily. So whenever you're investing in any debt product, first figure out your investing horizon. If you're not clear, so it is not that every time you have a cash flow, you are clear that when you need this money. So if you are not very clear, then liquid is the best alternate because it is a very efficient product. So if you look at liquid return for last 1 year, it is more than 7%. If you look at 5 years return, liquid return has been more than 8% CAGR. If you look at 15 years track record of liquid fund, they will deliver 7% plus return. So if you are looking at the cash flow on which you are not very sure when would you need it, I think liquid is one of the best strategy one could look at it. But a better alternate than liquid fund, though we are talking about debt fund only, a better alternate for somebody who's in 30% tax bracket is to look at equity arbitrage fund, but your investment horizon has to be minimum 3-year period because post-tax equity arbitrage consistently deliver 0.5% to 1% more return than a liquid fund product.
Okay, keep this in mind, viewers, that over Vijai Mantri in a number of shows in the past, they said that if your time horizon is over 3 years, you should anyways look at equity funds. The reason why we're doing this debt fund conversation is compared to, with all that surrounding the debt funds, compared to fixed deposits, Vijai Mantri and team JRL do believe that debt funds still provide a much better alternative. Now, let's assume that choosing the kind of fund, liquid or otherwise, it's probably the easier part. Look at the time horizon and do that. I'm guessing choosing which fund house and which fund within that house to put in might become a bit tricky because of all that's happened. So maybe look at a financial advisor, even if you're doing a debt market.
Yeah, I think you need to look at financial advisor as the one part. Second part, the beauty about mutual fund is that before investing, you can figure out where the debt fund has invested. So many people do have opinion about many corporates' names. So suppose they don't understand the names which is there in the fact sheet, they either consult their advisor or not to invest. They have a choice to exercise that option. But when we are looking at a debt mutual fund, we should not always compare with fixed deposit. We should also keep in mind that many investors are participating in NCD directly.
Yes.
They invest in corporate deposit directly.
Is that bad?
Of course.
Why?
Because the bank FD is a much better alternate than the corporate fixed deposit. Because bank
But
FD...
a lot of strong corporate houses, a Mahindra and Mahindra Financial, for example.
See, you start with Mahindra and HDFC. Then you see returns are not good. Then automatically people migrate to lower credit quality because once you start comfortable with the corporate deposit, then unlike US where there's only 2 AAA organizations, in India there are more than 70 AAA organizations and we have seen concern on the default even with AAA. So what will happen? You see, okay, HDFC is AAA, ILF is also AAA. So what is the difference in both of them? So you start with the HDFC, but ultimately customer do migrate to lower credit because the yields are much 1.5% more superior. Now in a bank FD, at least when you need money, you can exit it. There's no capital loss. Only thing is that instead of 7%, perhaps you'll get 4%. So at least you have exit. In corporate deposit, there are no exits. In corporate NCTs, there's no liquidity. So we recommend to investors, suppose you want to keep money in a bank deposit, alternate is bank and PSU debt fund. Suppose you want to invest money in a corporate NCDs or corporate FDs, a debt mutual fund is a far better alternate because you have a liquidity, You have a diversified portfolio. For instance, if you invest in a 5 debt mutual fund, you get exposed to more than 100 securities.
Sure.
So diversification is very important in customers' portfolio. And as I told you, in spite of all the challenges we are seeing, where some fund house has taken hit on the NAV, they wrote it off, which is actually the right thing to do, rather than the promoter taking burden on the balance sheet of the sponsor company. In spite of that, the average return has been 7.5%, which is not bad at all.
Yeah, just that it becomes tricky, so you need to be able to choose the right fund and the right quantum of investment as well. I think Vijay Mantri's point is well taken on that. Before we get to queries though, Vijay, some schemes that you would recommend. Let's say somebody's convinced with this argument, wants to invest into debt schemes right now. Let's say the time horizon is over 3 years. What are the schemes that you would recommend?
So we are recommending ICICI Prudential All-Season Bond Fund. We are recommending Kotak Dynamic Bond Fund, IDFC Bond Fund Income Plan, HDFC Medium Term Plan, and
SBI Magnum
Income Fund. And you could look at the track record of these funds, which has been very good.
So why are you recommending an SBI Magnum Income Fund when the 3-year returns for an ICICI Pro is much better?
You need to diversify.
Okay.
It is very important to diversify. You just don't go by immediate past historic return, how good they may sound. And if you look at this portfolio, the average yield has been 8.23% and is a compounded. In most fixed deposit, returns are not compounding at the same rate.
Sure.
So if you look at end corpus, the difference is very high.
Okay, so this plate is important. This is what Vijay Mantri and Team GRL's recommendations are on the debt funds in case you are convinced about investing in them. Some queries, Vijay. Not all of them need necessarily be only about the topic, but I will try and take some of them and get Vijay Mantri's answers on the same. Kinjal on Twitter writes to us, she's 23 years old, is a first-time investor who started her employment 6 months back. What are the funds that can help her save tax and generate return on investments? Kinjal, I must advise you, if you watch in the last week's show, we did recommend, Morningstar came in and recommend some of the tax-saving funds. But Vijay, any thoughts that you have? Save tax and generate return?
ELSS is the best option compared to any other tax-saving option you have. One option is bank FD, where interest is taxable, and they offer 3% and lock-in is 5 years. The second alternative is PPF, people invest, and the returns are below 8%, but the return is tax-free and the corpus is also tax-free. But is a longer 15-year lock-in period, and you need to invest every year. The most convenient is mutual fund. The advantage is that suppose you start in ELSS and you do SIP for 12,000 rupees or you do SIP for 10,000 rupees. 6 months down the line, you don't have money, you don't need to bother. Next year, you don't want to invest, no problem. It is not like insurance product, or it is not like a PPA where you have to invest every year. There's no compulsion. Nobody is binding you. And if you look at consistent performance of ELSS, over a 10 to 15-year period, then they generate 50% to 200% more return than PPF, but with intermittent volatility. So one return from equity is not linear. So one that need to go in the mind of investor that it is not like FD that every day it is going to go up. We get 15% CAGR, but the 15% CAGR come with 1 year 80% return, 3 years negative return, 2 years flat return, and then 1 year bumper year. So that one need to keep in mind. So,
okay, point well taken. Yeah. Janil writes to us on Facebook. He has invested 5,000 per month in Sundaram mutual funds since 2017. His portfolio is now down 20%. He wants to know if he can continue with this fund. He has a 3 years time horizon. I'm presuming 3 years from now.
Difficult to answer an individual without understanding his background and all that. But if your portfolio is already down 20% and your horizon is 3 more years, I think the fund will do well. Sundaram has a pretty decent track record, and if he's saying he started investing in 2017, so already almost 2 years behind his investment and 3 more years. If you look at 5-year rolling return of most of the mutual fund, they have been in positive territory. Now, second thing to look at is what is the probability of making 10% plus CAGR on 5-year horizon. So our study suggests that if you ever invested in most debt equity-oriented mutual fund for a 5-year period plus, you end up making positive return. Whenever your return is less than CAGR of 10%, you just need to increase your holding period by 6 to 9 months, and you get back to 8 to 10% CAGR. So my request to the gentleman is to stay invested for next 3 years, and he will probably get 10% kind of CAGR. Suppose it doesn't get 10% CAGR, he just need to wait for 6 or 9 months more based on our understanding of what happened in India in last 25 years.
Okay. Last question, maybe one more question for one more time. Pari on YouTube asks this question. Promoter borrowing from the mutual fund industry has recently come under public scrutiny in light of the fall in price of shares that are often pledged as collateral for such loans. Where does this leave the mutual fund investors? I think we part answered it, but Vijay, you want to come in again?
Yeah, first of all, borrowing against shares is a legitimate thing to do. It is perfectly legal. Fund house has been investing not for the first time, but many times in past. The lending sometime used to happen. Fund house would lend to NBFC, and NBFC would lend to the promoter, and sometimes good quality promoter do come to fund houses to borrow. So I don't think it is going to be a big challenge in my opinion. Total book is maybe 35 to 40,000 crore with the entire industry, and I don't see a big problem. There's too much hue and cry happening right now. You could see some pocket of challenges somewhere, but at industry level, I don't think they're going to be big challenge in my opinion. Perhaps you will see going forward regulator coming out with some more tighter risk management measure of total exposure of loan against shares in the mutual fund book. But currently, as I told you, you have to go to scheme specific. Suppose you look at your entire portfolio. You're hearing all the news in the market. When you look at the entire portfolio, of your total portfolio, only 1% is exposed to these kind of names, then I don't think you need to bother too much. And even on that, suppose, as I told you, if there is no exit load, if there's a tax liability has been taken care of, then I think you want to take money out and move in some other fund house, the same fund house or another scheme. So you could do that. That option is available. Unfortunately, that option is not available in NCD and fixed maturities plan.
Got it. All right, keep all of that in the back of your mind. If more people have queries, or if you haven't been able to answer your queries, do write into us though, and we'll try and post those questions to Team JRL and Vijay Mantri, and they'll try and answer some of those as well. But it's time out on this leg of the Mutual Fund Show. Vijay, thanks so much for joining me today. Really appreciate you joining in the show and giving us your thoughts and this lesson. And viewers, thanks for tuning in to this leg of the Mutual Fund Show. Stay tuned to Bloomberg Quint.